If you've ever found yourself jumping into trades before the setup is ready, you're not alone. Almost every trader does this at some point, and most blame it on the usual things: not enough skill, not enough experience, or not enough technical understanding. But the truth is far simpler. Most traders enter too early because they get caught in a psychological trap that tightens as the market approaches a cycle top. This trap feels logical in the moment, but it almost always puts you on the wrong side of the trade. Today, I want to walk you through 7 reasons why this happens and how you can finally break the habit of entering too early. Number 1, the fear of missing out. When the market heats up, especially during late-stage cycles, your logical mind quietly tells you to slow down and wait for confirmation, but your emotional mind has a different agenda. It whispers, "What if this is the moment? What if the big move is happening right now and you're about to miss it?" That single thought is enough to override your entire strategy. This is classic action bias, the brain's instinct to prefer doing something over waiting. And in trading, especially in fast markets like crypto, action bias becomes a powerful trigger. The faster the market moves, the faster your mind wants to react. That urge to make sure you don't miss out is the root of most early entries. Number 2, cycle tops create false urgency. Here's where it becomes dangerous. As a market approaches a cycle peak, everything becomes louder and more chaotic. Candles move faster, wicks get longer, breakouts look cleaner until they fail suddenly. Reversals come out of nowhere. Volume surges unpredictably. This environment creates the illusion that time is running out. You feel like opportunities are slipping through your fingers and you need to act quickly. Cycle tops are emotional pressure cookers. The combination of hype, volatility, and rapid price swings makes you feel like waiting is reckless and reacting is responsible. But that's the trap. Cycle tops punish impulsive entries more than any other market phase. Number 3, the mistake you repeat without realizing it. Most early entries follow the same predictable pattern. It starts when price approaches a resistance level and momentum picks up. You feel that spark of excitement. This could be the breakout. Then price dips slightly and you tell yourself it's a healthy retest. It dips again and you convince yourself it's a deeper retest. Then suddenly the chart gives a sharp upward push. It's quick enough to trigger adrenaline and strong enough to make you feel like you're late. So you enter. Not because you saw confirmation, but because you couldn't handle the thought of missing the move. Then just as quickly as it rose, the breakout fizzles. Price reverses, your stop gets hit, and you end up frustrated, telling yourself, "I knew I should have waited." But when the next cycle low comes around, the exact same loop repeats. The problem isn't your strategy, it's the emotional timing inside that loop. Number 4, why you're most impatient at the worst possible moment. One of the biggest emotional blind spots in trading is realizing that your impatience peaks at the exact moment the market becomes the least trustworthy. Cycle lows create fear. Fear makes you wait too long. Cycle tops create excitement. Excitement makes you act too early. Your emotional timing becomes completely inverted from the timing the market actually requires. When a market is extended far above key moving averages and attracting heavy retail participation, your instincts become unreliable. You enter early because the entire environment is engineered to make you feel like the opportunity is now or never. But this is precisely when waiting is your greatest edge. Number 5, the market's favorite trick: false breakout energy. Every cycle top has a moment where the market starts producing quick, short-lived breakouts. These breakouts are designed to look like the real thing just long enough to lure impatient traders into bad entries. You see a big candle, you feel that rush, and your brain instantly projects into the future, imagining the whole move that might follow. This moment is where discipline collapses. But when you step back and look at it through a cycle lens, you realize these fast, deceptive breakouts are a signature behavior of overheated markets. They are not signs of opportunity, they are signs of exhaustion. Once you understand that, the desire to jump early starts to lose its power. Number 6, how to stop entering early. Breaking this habit doesn't require superhuman discipline, it requires clarity. The first shift is learning to wait for structure, not spikes. Real breakouts don't need to trick you. They hold above their levels. They show stability. They give you time to think. False breakouts demand immediate action. They pressure you. They feel urgent. And urgency is your first warning sign that you're about to enter too early. The second shift is understanding where you are in the bigger cycle. Late cycle environments produce the highest number of trap breakouts. When you recognize that the cycle is stretched, you naturally start to slow down. And once you slow down, impatience has a harder time grabbing hold of you. Another powerful tool is defining your entry criteria before the market starts moving. When the plan is clear, you're no longer negotiating with your emotions in real time. You're simply waiting for the market to meet your conditions. And finally, zooming out to higher time frames calms your mind. Lower time frames create noise. Higher time frames reveal truth. Cycle tops look confusing on the 4-hour chart but incredibly obvious on the weekly. Number 7. The shift that changes everything. If you want to break the cycle of early entries, you need one mindset shift. Trading is not about jumping early. It's about entering correctly. You don't get rewarded for reacting fast. You get rewarded for waiting until the market confirms that the trade is real. Most traders try to win by acting quickly. Successful traders win by acting precisely. Once you understand that, early entries start to feel reckless instead of exciting, and waiting begins to feel powerful instead of passive. In closing, the loop can be broken. If you've struggled with entering too early, you're not broken and you're not undisciplined. You've simply been reacting to the emotional environment that every late-stage cycle creates. But once you understand how those emotions form, and once you recognize the signs of a deceptive breakout, the loop starts to lose control over you. You stop chasing, you stop rushing, you stop imagining the move you might miss, and instead, you enter trades only when the market clearly shows you it's ready. After all, patience in trading is a virtue, and mastering it is your surest way to success.